Hello everyone, welcome back to another update on our Lunch and Learn webinar series. I'm your host, Mayur Thaker. I'm an equity strategist here at Zacks Investment Research. And this is an update on an earlier video that I made back in September, I believe it was. And we're now in the middle of November. And this is, I think, something very near and dear to my heart, and it's something that I've spent years studying. And it's kind of an esoteric subject. Not a lot of people look into what drives the price of gold, and I believe that there's a lot of important information that we can get from assessing the primary trend of gold in any market environment. So this video is dedicated to updating what I had discussed in September to give us the latest information, but specifically about what gold is communicating to us regarding the current environment now that we have, Trump back in the White House. So let's get started with that. A lot to get into here. So, what we have, what I shared in the past video, and I just updated it through October 31st, is that gold has surprised investors over multiple time frames. People are surprised to see this because, most people are not focused on gold, but, gold has been with us now for more than 50 years, really more than, centuries, millennia, potentially, but in modern markets, gold has been trading freely to the dollar for about 50 years, ever since we left the gold standard in 1971. That was a seminal moment that really ushered in, a new era of currencies that are not really backed by anything other than the full faith and credit of the government. But if you look at it over many different time frames, gold has outperformed even the S&P 500 over different time frames. Now, if we look at the full 50-year picture, since we delinked from the dollar was delinked from gold, over that overall time frame, gold has underperformed the S&P 500. You can see that the gold's return per year, these are all annualized figures here. So on a per year basis, over 50 years, gold has risen by about 5.7%. The S&P has annualized return of about 12% over this 50-year period. This is including all dividends, by the way. So this is a total return, not the price return. So that's important to distinguish. If we look at just a price return, then these numbers are actually even better when it comes to gold's performance relative to the S&P 500. But with dividends, the spread does become wider in favor of the S&P 500 over a 50-year time frame, right? You can see gold is underperformed by about 6% per annum over 50 years, but it all depends on your time frame. If you look at over the 25-year time frame, gold has actually beaten the S&P 500. Over 10 years, gold has underperformed the S&P 500 per annum by about 4%. Over 3 years, though, gold has rocked the S&P, and this has been really interesting because we have been in an extraordinary bull market for the last 3 years, and yet gold has beaten that, up 15.6% per year over the last 3 years. And the lion's share of that has happened over the past 1 year, where gold has rocketed 36.9%. That's slightly under the S&P's return. The difference is only 1.1%. However, you can see year to date, we're once again, trouncing the S&P 500. And this has been during a spectacular bull market in the equity market here. So, my main question here is, what is this communicating to us? Well, here you can see the full 50-year time frame. Obviously, there's no comparison. S&P has beaten, gold by a long shot. But again, time frame matters. So over a 25-year time frame, gold has rocked the S&P 500. And we've been through an extraordinary bull market really over the past 15 years. And yet, despite that, gold has outperformed. And so gold is really beating the market over the past year and year to date. So what is this telling us? Well, gold, it really behaves differently from the consumer price index. A lot of people think that gold is, an inflation hedge, and that's true to a degree. But the relationship with the CPI has been mixed, and this chart I shared in my last video in September, it's really just the same here, but you can see that over the course of the last 50 years, ever since gold has been traded freely relative to the dollar, it's had a mixed relationship with the CPI. Sometimes it has a very linear relationship with the consumer price index. As we saw throughout the 1970s, we saw that the inflation cycle of the early 1970s was accompanied by a surge in the price of gold, and then that deceleration, the rate of change going down in CPI was accompanied with gold coming down, and then that resurgence of inflation, gold went back up, and then finally we defeated inflation in the 1980s, and gold went into a bear market and never really came back from that. So there was a pretty good linear relationship with gold and consumer prices throughout the 1970s. But then after that, it's been mixed. You can see here, the CPI really shot up in the late 80s to early 90s, but gold was muted the entire time. And then even now, we've had, the highest inflation in 40 years, really going back to the 1970s. And yet gold was basically doing nothing this time right now in the past couple of years here. It only recently started shooting up over the past 1 year. So it's been mixed. And here I just zoomed in here, which is really interesting because, we had, again, the highest CPI in 40 years, and gold really did nothing. And CPI is finally coming down. We're finally declaring victory over inflation. And gold is now waking up out of the doldrums. So what's going on with that? And the reason for this, in my view, is that gold is not a direct proxy to consumer price inflation per se. It does have an indirect relationship, but really the more direct relationship, or the explanation behind gold, is that gold is a reflection of forward-looking expectations of excess liquidity. That's the operative word here, excess. Liquidity is, defined broadly speaking as the supply of money. That is a monetary phenomenon that's determined by the Fed. And excess liquidity is when the market believes that there's too much money supply relative to money demand. So the simple equation is that excess liquidity is simply the spread between the supply of money and the demand for money. The demand for money is determined by private consumption. So here I just have it in a sort of a different way. The supply of money, one of which you can use to measure, is the M2 money stock. That's one way of measuring money supply. There's many different methods, but that's one of them. And then here is the demand for money, and that is determined by private consumption and investment.
Yep.
So the demand for money rises when growth expectations rise from the private sector, and the demand for money declines when growth expectations from the private sector go down. And that's what we define as recessions. So excess liquidity is simply when the spread between the two rises. Okay, so one way to possibly forecast the direction of future excess liquidity is looking at the trend of the federal budget deficit or surplus, right? You can see here in this chart, right now, we are currently running the biggest budget deficit relative to GDP in decades. I mean, it's the fourth largest. You can just see on this chart here, the biggest deficit we've ever had really in the last 100 years has been during World War II, as we saw here. The budget deficit exploded for reasons that we all know of. And we've never really had a deficit this large. This red line here is where we are currently as of August, right? This is an annual number. This is an annual chart, so we don't currently, the way I calculated this is by adding up the trailing 12 months of the deficit relative to the current level of GDP. So because this is an annual chart, you can't see the most recent data here because this is only going through fiscal year 2023. But the red line represents where we are right now through August of 2024, and that number is 7.2%. And as you can see here, it's the fourth largest in the last 100 years. The biggest was World War II. The second biggest was during COVID. The third biggest was during the Great Financial Crisis. And the fourth largest is right now. And, everyone can say, well, that was a pretty good reason to be running a deficit, right? World War II. During COVID, where, we had to impose emergency measures, that was a pretty good reason to run a pretty big deficit. During the Great Financial Crisis, that was a pretty good reason to be running a big deficit as the financial system was brought to its knees. But what about right now? There's no real national emergency that we're going through as of right now. And yet we're running a deficit as if we're in a major national crisis. And so, if you look at this chart, this shows you the price of gold in the color gold. And the black line here represents the trailing 12-month budget deficit. And you can see just off of this chart alone, the inverse relationship that gold has with the budget deficit. You can see here that gold had a tremendous rise, basically throughout the 2000s and peaking in 2011, as gold accurately forecasted rising budget deficits. You can see here that the black line continues to go down because that is a negative number. As we go further down, that means the deficit is getting deeper and deeper into the red. And over here on the right side is the axis for gold. So gold rises as governments engage in bigger and bigger deficit spending. I believe that the reason for this is because as deficits rise, right, excess liquidity continues to rise, because in order to finance these deficits, we need to raise the money supply, right? And so if you look at it statistically speaking, this deficit has exploded to the downside, right? Meaning it's gotten deeper into the red. And that's the real reason for this big gold rally that we've seen here. This is basically the gold market saying that they expect rising excess liquidity because the deficits are getting deeper and deeper into the red. So if you look at it, statistically, if we run a regression between the two, the end result is that gold has a 70% leading correlation to the budget deficit or surplus. So as deficits rise, liquidity must eventually rise to accommodate it, right? So with gold rising materially over the past year, I believe that it's forecasting increasing fiscal deficits, which has already crossed $2 trillion or 7.2% of GDP. However, and this is the major update that we got since the last video, we just went through a pretty big election, as we all know, and we know who won. And look at the reaction to gold, post-election. Ever since we got the election, gold has taken a major hit, down. Now, I don't want to read too much into it because this is just, we're zoomed in, right? This could be, missing, the forest for the trees because we're looking at it very, really closely. Gold has had, big hits in the past only for it to rise up again. So I don't want to get too ahead of it. But I do want to just point this out, that gold has been notably weaker ever since Trump won the election. And so my view is that with the sweeping Republican victories, right, in November, not just Trump winning, but the Republicans, taking the Senate and holding the House, the market might be in the very early innings of a significant repricing in gold as it reassesses the direction in which both sides of the equation for excess liquidity go. So we have the U.S. federal deficits and therefore the supply of money potentially changing course. and private sector GDP growth, and therefore the demand for money, also changing its course. So putting it all together, gold's decline could be signaling that the era of massive deficits may be coming to an end, but it's still very early. So again, if you go back to the equation here, gold rises when excess liquidity rises, right? And so gold can rise when, the Fed is increasing the money supply faster than the private sector's demand for money is rising, okay? Or we could have rising excess liquidity if the Fed's, money supply is being held constant and the demand for money from the private sector is declining. So, we have a dual sort of edge as to understanding why gold could be rising. Gold could be rising because the Fed is printing too much money. There's too much money supply out there. There's too much liquidity out there relative to the current level of demand of private consumption and investment. Or the Fed could be just kind of holding still, and the outlook for growth could be coming down. That could lead to excess liquidity as well. So in either case, gold could be rising. We have to determine for what reason gold is rising or for what reason gold is falling. So with gold rising over the past year, that could be because there's too much money supply, or that there could be growth concerns, or it could be a combination of both. And we have seen that the M2 money stock has been rising. And at the same time, if you've been following, my channel here, and my past videos, I have been raising concerns about slowing private consumption investment as reflected in the monthly jobs picture over the past 12 months. Jobs have very clearly been slowing, and we're going to take a look at that as well in the next couple of slides here. But there could be a combination of both going on at the same time, which leads to rising expectations of excess liquidity. And remember, gold is a forward-looking market, just like stocks are. And so it looks forward. So it looks at what the Fed is doing at the money supply, but also it looks at its own expectations for the future outlook of private consumption and investment. So we could have a situation where both are kind of diverting from each other at the same time. The Fed is increasing the money supply, and we have a loss or decreasing demand for money or expectations of demand for money. And that could be why gold has really soared. It's not just beating the market, but it's beating the market in one of the strongest market years that we've had in a very long time. That's significant. However, again, this could be in the midst of a repricing, because if we look at the Trump agenda, there are bullish aspects of it. There's also bearish aspects of it too, so I want to just quickly highlight that. So in my view, again, this is just my opinion. None of this is a statement of fact. It's just my view, my interpretation of what's going on. I believe that the bullish aspects of the Trump agenda, which is bearish for gold because it's bullish for growth expectations, is that if he is able to successfully renegotiate the trade deals, right? Remember, Trump has been big about trade. He's been big about using tariffs as a negotiation tactic to renegotiate trade deals that we have with the European Union and with other countries around the world, other very rich countries around the world. If he's successful at renegotiating these trade deals to either make American exports more attractive abroad, or to incentivize foreign companies to set up shop in the U.S., right? There's a kind of a dual approach to doing it. So if he is able to say, well, hey, European Union, hey, Japan, hey, South Korea, you guys have, really high import tariffs on American goods. If you don't bring these down, we're going to put import tariffs on your stuff coming into the U.S. So the outcome of that is either that they reduce their import tariffs and therefore make American exports to those countries more attractive, therefore opening up new markets for American companies to compete in. Or if they don't reciprocate, then it incentivizes those foreign entities or even domestic entities to set up shop in the US so that they don't have to deal with the high import tariff. That would be bullish for US investments, US manufacturing, and US jobs. And again, that would be bullish for the economy, that would be bullish for private sector consumption and investment, and therefore bearish for gold. Also, the other part of it, which he has floated, is bringing the corporate tax rate to potentially 15%. That would be very bullish. I would love to see that number come even lower, but a 15% corporate tax rate would basically make the U.S. the lowest corporate tax rate among the OECD countries. That would be a magnet for investment and business formation. Remember, the corporate tax rate, we kind of have triple taxation in this country, because companies pay, a 21% corporate tax rate. And then, after they pay that tax, we, the investors of these companies, pay a capital gains tax, a dividend tax. And so, these dollars are basically triple taxed. So as that corporate tax rate comes down, the effect of triple taxation decreases. Also, the compounding effect of tax expense comes down, because remember, and this tax is not applied just once, right? We have very complex supply chain. So remember, the corporate tax is being assessed at every point in the supply chain. So that does contribute to inflation, because remember, prices are a reflection of total expenses that companies have. So if we reduce the corporate tax rate, that is actually bearish for inflation, meaning prices can come down as we reduce the corporate tax rate, because remember, prices are a function of expenses incurred at every point in the supply chain. We have manufacturers that produce raw goods. They sell their materials to parts manufacturers. So the manufacturers have to pay an income tax, and then the raw parts, the parts manufacturers have to pay an income tax, and then the wholesalers that buy those parts, they have to pay an income tax, and then the wholesalers have to pay an income tax when they sell to the final goods manufacturers, and then the final goods manufacturers have to pay an income tax as well once they sell to you, the end customer. Or there could be one more step, which is that the retailer that finally buys from the finished goods manufacturer has to pay an income tax as well. So there could be 5 or 6 or even 7 or 8 points in the supply chain, each of which are paying that 21% income tax at the corporate level before it finally ends up in our hands. So these taxes compound at every point in the supply chain. And so whenever you bring that corporate tax rate down, that could be a very, very strong disincentive for inflation, which is very bullish for consumers. So bringing that corporate tax rate down to 15%, which I believe Trump has floated, I believe that the Republicans in the House may be favorable to that. That would be a magnet for investment and business formations, but also a very strong antidote to inflation. So these are all bullish aspects of the Trump agenda, I believe, which is bearish for gold. However, it's not all bullish, because we have other ideas being floated too about mass deportations of illegal immigrants and mass layoffs of federal employees. Now, the second part of that might be bullish in the long run, because it makes the government leaner, more efficient, which means that it consumes less, and that therefore that affords even greater tax cuts back to the private sector. That, I believe, is bullish, right? But even though it has long-term positive effects, that will most likely cause significant short-term pain. Because remember, whether they're here illegally or not, they are suppliers of labor and they are consumers. And so when you remove, anytime you decrease the population for any reason whatsoever, even if it's for a good reason, you will see a hit to GDP. And that's just simple math. When you reduce the population size, you remove labor and you remove consumers. And when that happens, you do take a hit to GDP, all else held equal. At the same time, when you have mass layoffs of federal employees, that will be a negative to GDP too, because right now, the job market is very dependent on federal hiring. We're going to take a look at that chart as well. So again, this is both in the long run bullish, but that won't come without significant short-term pain. Putting it together with regards to gold, rising gold means that there's rising excess liquidity. Falling gold, not enough liquidity. Flat gold means there's well-balanced liquidity. We want gold to be flat. That's what's bullish in the long run. When gold is flat over extended periods of time, it means the money supply is well-balanced with credit demand, money demand. And so true bull markets are when stocks rise while gold is mostly flat. We want that to happen. So in my view, gold is still signaling recession because the overall trend is still up. But, because it's had, this drop, due to fundamental factors with the incoming Trump administration, it may be amidst a major repricing to reflect stronger economic growth ahead, which mops up that excess liquidity that's been built up over the last 15 years. That's a bullish scenario, but it's a double-edged sword since the economy right now is highly dependent on government spending and jobs. If you look at this right here, this shows true private payrolls growth. So this is looking at the jobs picture. If you've been following my other macro videos, I've been watching this like a hawk. And we just got, the October jobs report, just before the election. And lo and behold, for the first time this cycle, the sort of the true, what I call the true private payrolls growth on a 3-month moving average too. It's not just looking at a single month. This is looking at the 3-month moving average of true private payroll growth. So this is looking at total non-farm payrolls minus government, minus education, and minus healthcare. Okay, the reason for doing this is because obviously for obvious reasons we back out the government, so we look at the private sector only. But then I also back out education and healthcare job growth, because education and healthcare, those industries are non-cyclical in nature, meaning they are not affected by the business cycle. They are always increasing headcount no matter what's going on. So throughout the 2008 crisis, throughout the 2001 recession, throughout the 1991 recession, basically throughout each of these times, every single recession going back 50 years, government, education, and healthcare have never cut the headcount. They're always growing. So therefore, they are not reflective of the underlying business cycle, right? So by backing them out of the non-farm payrolls, you get a much clearer signal of the business cycle. Okay, so this is looking at the actual cyclical economy rather than being distorted by non-cyclical factors. And right now, government has been on a hiring binge, as has been healthcare as well. Not to say that healthcare jobs aren't real, right? Not to say that they're not good jobs. Not to say that they're not good paying jobs. They are. But by backing these out from the non-farm payrolls, you get a clearer picture of the true cyclical economy. And you can see here that every single time the 3-month moving average of the remaining true private sector has gone into a contraction, we have been in a confirmed recession in 6 to 12 months afterwards. And so we saw that here in 89. In the second half of 1989, we went into a recession the year after. This happened in 2001. We went into recession just 6 months after. Here we saw in late 2007, we were in recession not too long after that. COVID, there was basically no time to react to that. That was just a straight drop, so that wasn't really a true recession. But look at what happens now. We are in recession right now. If we were to use, this historical relationship and extend it to now. So what this is saying is that the true private sector, meaning outside of government, education, and healthcare, again, collectively, the industries that never cut jobs. So if you look at everybody else, which in normal bull markets explains about 80% of all job creation, that's where the jobs really are. So again, 80% on average during bull markets of all jobs come from the true private sector. And right now, the true private sector is in contraction. So right now, the job market is very much dependent on government hiring, as well as education and healthcare hiring. So if, the Trump agenda, which is looking at government hiring in a very, very, strong way, as, we know Trump has hired Elon Musk and Vivek Ramaswamy to cut government headcount and to, find efficiencies in government spending. Not without getting political, I'm not trying to be political at all, but what I'm saying is that right now, the job market is heavily dependent on government, for hiring. So if you add back government, then this number is positive. But without government, this number is negative. So if they take an axe to government hiring, I believe that that's going to send the economy into a recession. Here you can see another chart, which I really like to look at. This is the permanent job loser. So remember, a big reason for why the unemployment rate has gone up so far has been mostly because labor supply has gone up for, a number of reasons. But layoffs have been low, which is true. But as of the October report, layoffs have started to pick up in a big way, as we see here from the permanent job losers subcategory of the household survey that we get from the monthly jobs report. And you can see that it's now sliced through the 3-year moving average. That's a 36-month moving average. And as you can see over the last, there aren't a lot of, it's not a big sample size, but you can see that every single time we've sliced through the 3-year moving average, layoffs have really snowballed thereafter. And that's because it's got a self-fulfilling prophecy, part of it. When layoffs start, they really get going. It's really hard to put the genie back into the bottle once it's out, because of its sort of momentum nature. One job loss triggers another, which then triggers another, which then triggers another. And so this is a snowballing effect that you really don't want to see get out of hand. And I believe that we just got a major breakout of this number as of the October jobs report. So we'll see if this number comes back down. But just objectively speaking, between these two charts, these are the two charts that I'm looking at like a hawk. The true private sector payroll growth and permanent job losers. This measures the number of layoffs, and this measures the total job growth from the private sector, which is what matters the most. You can see during healthy bull markets, as we had throughout the 2010s, the true private sector generates somewhere between 100 to 200,000 jobs on average per month. That's a healthy market. This is not a healthy market, objectively speaking. So we need this number to come back up. But, if the Trump administration takes an axe to government hiring, I'm just saying right now, the private sector is not going to be able to absorb that extent of federal job losses. So again, the most important thing to take away here is that the order in which the Trump agenda is executed, in my view, again, all my opinions, not a statement of fact or anything like that, just an opinion, but the order in which the Trump agenda is executed will matter greatly on the outcome that we see here on economic growth. So if the deportations and the federal layoffs come first, then there will be a recession before the long-term gains take effect. So there will be short-term pain for the long-term gain. But if the pro-growth side of the agenda comes first, then it may entirely offset the short-term negative. So we will see which side of it comes first. I do believe that they have some smart people that know this, but it remains to be seen. So takeaways: continue watching gold. I would watch for a break below the 200-day moving average. That may signal a trend reversal and therefore a very bullish outlook. But if the gold bull trend simply continues to the upside, right, then the base case of recession still holds. Furthermore, that complicates it is that the S&P right now trades at a very highly elevated 22.5 times forward PE. And that the key operative word there is forward, because that assumes a very bullish growth expectation for the next year. So the bar is very high. In fact, it's in the top decile over the past 30 years. So as such, the forward earnings yield of the market right now is at parity with the 10-year yield. Historically, market returns over the following 5 years have been very poor at these levels. So, until we see what happens, I would continue to long the Zacks earnings certain proxy over the S&P 500 until we see a resolution of where jobs go and ultimately where gold goes. So keep watching gold. A breakdown below the 200-day moving average, I believe, is very bullish. That means that the gold market is betting that these negative trends in the jobs picture will turn around and return to a healthy, bullish environment. But if the gold rally continues, right, if we never break below the 200-day moving average and, gold continues higher, then there are causes for concern. And again, it doesn't help at all that the S&P is trading at a very rich valuation. So expectations are very high. The bar is very high. And I believe it's going to be very difficult for that to be met unless if the bullish part of the Trump agenda is executed first. So the order in which that happens is going to matter very greatly. But for now, until we see a resolution of where all of this ends up, I would remain long the Zacks earnings certain proxy because there still remains to be uncertainty. I don't think that just because we have Trump in office, it's necessarily all bullish. Certainly a lot of things to be bullish on. But again, the order in which that is executed is going to matter greatly. The long term, though, I think is still very bullish. But it may not come without short-term pain. So for now, I would remain long the Zacks earnings certain proxy because there is no certainty with that. That's the reason why we call it the Zacks earnings certain proxy, because these companies are going to do well no matter what happens. They've been battle-tested. They've been recession-resistant. These are durable moat companies, companies that are just phenomenal, steady compounders. And here you can see exactly why we're bullish on these companies, because as you can see here, no matter what's been happening, no matter what environment we're in, these companies continue to execute well and therefore grow earnings. So until we see a resolution of which way the market breaks, I would watch gold. gold is going to be the signal for whether we get first a bullish outcome right out of the gate, or if we first get a bearish recession followed by a strong recovery. The order in which this all plays out remains to be seen. For now, the base case is still recession, unless if we see gold, break down. So gold is a very important macro, indicator in my view. But here you can see the aggregate Zacks earning certain proxy. These are, this portfolio is really built for long-term durability, for long-term visibility. A portfolio that you really don't need to be making any kind of macro bets on. That's the whole point of the portfolio. This is, continues to be what I recommend as your core equity holding. And then you can supplement that with, higher risk depending on the outlook that you have for the economy. So again, I hope you found this helpful. If you have any questions, please do reach out to us. I'd love to hear from you. Any feedback, even if you have a disagreement, I'd love to hear that as well. Please reach out to us at 1-866-794-6065 or send us an email to strategycall@zackspro.com. All right, thanks everybody. Talk to you soon. Bye.